Think you know exactly why the market is rallying today? Well, think again. We're dismantling the complete illusion of retail trading right now. I'm going to show you the strict mathematical truth behind market microstructure, because, let's face it, you've been lied to about price action for years.
But first, a quick mandatory reality check. This is our legal disclaimer. This is not financial advice. It's for educational purposes only, and investing always involves a risk of loss. Look, this explainer is a highly technical briefing meant strictly for advanced participants and macro traders. If you're just looking for basic financial advice, you're absolutely in the wrong place.
Listen to me very carefully. If you are buying massive green candles, you are mathematically engineered to lose. And today I will show you the exact order flow proving Wall Street is using your FOMO as their exit liquidity. All we ask is that you hit the like button and subscribe to the channel right now. Your support allows us to keep bringing you this elite level of institutional flow analysis.
Seriously, drop a comment below with the last ticker that trapped you. We've all been there. You see a parabolic breakout and you think it's a massive signal to buy. The truth is, that breakout was specifically designed to steal your capital.
Let's look at retail belief versus institutional reality. You think a big green candle is a signal to jump in, but it's actually a carefully engineered exit trap. Therefore, you absolutely must stick around until the very end of this explainer, because I am going to reveal exactly how smart money tracks hidden accumulation to buy before the chart even moves.
All right, let's pivot straight into the ground truth of all this, the actual mechanics of exit liquidity. We need to quickly strip away the retail illusion you're used to and expose the stark institutional reality of market scale. 10 million. Just let that number sink in for a second. See, as a retail trader, you can buy or sell 100 shares without causing a ripple, but a mega hedge fund, they literally cannot simply sell 10 million shares on a red day without completely collapsing the price and destroying their own execution. So what do? They mathematically require retail FOMO on green days to absorb their massive distribution.
And that brings us to the core concept, exit liquidity. This is the institutional practice of using retail panic buying, your FOMO, as the necessary counterparty to offload their massive positions. That huge green candle, it isn't a show of strength. It's actually a glaring sign that smart sellers are just stepping aside to hammer retail at a much higher price.
Let me break this down with a simple fifth-grade translation. Think of it as the nightclub trap. It's exactly like a trendy nightclub. The promoters hype the place up, they form a massive line outside, and they make it look like the absolute place to be. But the VIPs, the ones who actually own the club, they are sneaking out the back door with all the cash right at the exact moment you're paying the cover charge to get in. In the markets, retail is that line outside. Institutions are the VIPs out back.
So why does this keep happening? It all comes down to informational asymmetry, the lit exchanges versus the dark pools. There is a massive, fundamental disconnect between the lagging indicators that retail traders practically worship and the highly predictive tools that elite allocators are actually using. Think about it. Public markets worship basic candlestick patterns and moving average crossovers. But over in the institutional dark pools, they are strictly tracking block trade sizing, VWAP deviations, and unusual option sweeps. Therefore, elite allocators are fading the breakout entirely systematically while retail is sitting there staring at 100-year-old drawings on a lit exchange. 40%, roughly 40% of all U.S. equity volume happens in these dark pools. So that public lit chart you are staring at all day, it is quite literally a fraction of the actual truth.
So, where exactly does the smart money look? They don't look at standard retail charts. They rely heavily on SEC 13F filings, institutional platforms like Quiver, and highly advanced dark pool scanners. They are tracking the real dark pool prints and those unusual option sweeps to spot accumulation during the boring, low-volume consolidation weeks, exactly when retail is completely asleep at the wheel.
Let's translate this again for that fifth-grade layer. Accumulation versus distribution. Smart money literally buys the boredom. That boring, sideways, choppy volume, that is accumulation. And what do they sell? They sell the euphoria. Those high-velocity, massive green candles, that is distribution. They accumulate when absolutely no one cares, and they distribute when everyone is losing their minds with euphoria.
All right, let's move straight into the hard quantitative proof, the actual order flow mechanics of spotting this trap. I'm going to detail exactly how you can spot this structural liquidity trap in real time, well before a liquidation cascade completely destroys your portfolio.
The absolute secret here is volume delta.
Simply put, this is the net difference between aggressive buying, participants actively hitting the ask, and aggressive selling, participants hitting the bid. We have got to shift our focus completely away from passive price action and instead point a microscope directly at the aggressive underlying intent of active market participants.
Look at what happens structurally. When price breaks out vertically, but the underlying volume delta is negative, meaning there's actually more aggressive selling happening than buying, you will notice how institutions are just absorbing all those retail market orders with an absolute iceberg of limit sells. This right here, this is the structural trap hiding in plain sight.
And it gets perfectly confirmed by the MACD trap. You'll see price making a higher high, but the MACD is making a lower high. This critical MACD divergence, especially when combined with a negative volume delta, is the ultimate warning sign of structural exhaustion. If you see this, you absolutely cannot ignore it.
Because the aftermath of this setup is always brutal. When the retail buying power is finally exhausted, those trap stops trigger a violently fast liquidation cascade. The institution sells at the peak to the retail buyers, triggers your stop losses on the way down, and then simply buys their shares back at a massive discount using your sheer panic.
Which brings us to the ultimate payoff of this explainer. You have to trade the flow, not the candle. You must abandon those lagging public charts right now and start embracing the reality of market microstructure.
In a market run by algorithms, the chart is a lie, and the order flow is the only truth. Stop buying exhaustion and start tracking the dark pools. Hit the like button, subscribe to the channel, and drop a comment below with your specific thoughts on tracking institutional flow. Ultimately, you have to ask yourself, the next time you see a massive green candle, will you be the VIP sneaking out the back with the cash, or just another retail trader waiting in line to pay the cover?